Welcome to Wealth Campus, your ultimate destination for all things investing and personal finance. Whether you're a seasoned investor or just starting on your financial journey, you've come to the right place. Today, we'll uncover the secrets to evaluating initial public offerings and spotting those promising opportunities. If you're ready to make informed decisions that can potentially lead to outstanding returns, you've come to the right place. In this concise guide, we'll learn how to research and assess companies going public, providing you with the knowledge and tools to seize those golden opportunities in the stock market. With our expert insights and valuable tips, you'll learn how to dissect the IPO prospectus, evaluate company valuation, and manage potential risks effectively. So, if you're ready to take your investment game to the next level and make informed decisions about IPOs, let's dive in. Welcome to Evaluating IPOs. How to spot promising initial public offerings. You might have heard about them, but do you really know what they are? An IPO is when a private company goes public, offering its shares to the general public for the very first time. But why do companies take this leap? By going public, companies raise capital to fuel their growth, expand operations, and embark on new ventures. It's like a grand entrance into the stock market. So, whether you dream of investing in the next big thing or just want to understand IPOs better, stay tuned as we break it all down for you. When it comes to IPOs, knowledge is power. By conducting in-depth research, you can unlock the true potential of these exciting opportunities. So, what should you focus on during your research? We've got you covered. Dive into industry trends, where groundbreaking innovations can lead to explosive growth. Examine company financials, like revenue, profits, and debt, to gauge their financial health. And don't forget market conditions. External factors can sway an IPO's trajectory. Next, let's dive into the heart of IPO analysis: the company's business model. A strong business model is the backbone of any successful company. We'll dissect it to understand its strengths and potential. Discover competitive advantages and unique selling points that set the company apart from the crowd. But, can it stand the test of time? We'll assess scalability and growth potential to ensure a bright future. Let's evaluate financial performance of a company. To begin, we'll closely examine the profit margin. Typically, a healthy profit margin falls between 10% to 20%. Higher margins might indicate strong pricing power and cost control, but this varies across industries. Next up, revenue growth. Rapidly growing companies often boast annual growth rates exceeding 20%. Steady revenue growth demonstrates the company's ability to capture market opportunities. Now, let's talk about the debt-to-equity ratio. Ideally, a lower ratio, around 0.5 to 1, is preferred, indicating lower financial risk and potential for sustainable growth. The current ratio assesses the company's short-term liquidity. A ratio above 1 to 1 or higher, signals the company can meet its short-term debt obligations. Moving on, we have return on equity, ROE. ROEs above 15% are often seen as desirable, showing efficient utilization of shareholder investments. Earnings per share, EPS, growth is another essential factor. Investors look for consistent EPS growth over time, indicating improving profitability and potential for stock appreciation. Lastly, we'll explore the gross margin, which typically falls above 40% to 50%. Strong gross margins reveal the company's ability to maintain profitability after accounting for direct costs. They are the architects behind a company's success. So, let's unlock the secrets and reveal the power of strong leadership. Engage in thorough research, read interviews, and analyze their statements to get a sense of their leadership style and communication skills. Start by examining their backgrounds, education, and work history. Look for leaders with relevant industry expertise and a history of success. Seek leaders who have experience leading companies through different economic cycles, demonstrating adaptability and resilience. A strong management team is the backbone of any successful company. It drives the organization towards growth and prosperity. But who are these key executives? We'll assess their qualifications and experience to understand if they're up to the task. To gauge their execution capabilities, look at their past accomplishments. Has the leadership team delivered on previous promises and objectives? Next, let's dive in and uncover the market's hidden treasures. A company's product or service must resonate with its target market to succeed. We'll start by thoroughly researching the company's offerings and understanding how they address specific customer needs. What are the main industry trends, market size, and growth projections? Now, let's assess the company's competitive advantage. What sets their product apart from others in the industry? Market research is essential to understand customer perception. High adoption and retention rates are strong indicators of product-market fit. By closely monitoring customer feedback and reviews, we can fine-tune the product's fit. Remember, the product-market fit is an ongoing journey of adaptation and improvement. Remember, these are just benchmarks. Every industry and company is unique. Reviewing the IPO prospectus. It's like uncovering the company's DNA. So, let's unlock the secrets and gain insights from this treasure trove of information. An IPO prospectus is a comprehensive document that provides vital information about a company going public. So, where can you find it? Most prospectuses are available on the company's website or through regulatory bodies like the SEC. Now, let's decode this treasure map. Dive into its financials, revenue, profit margins, and any potential risks. It's essential to be aware of potential pitfalls that could affect your investment. Brace yourselves. It's time to understand the numbers game that drives the stock market. We're unlocking the mysteries of IPO valuation and pricing. IPO valuations are the heartbeats of stock market launches. But how are these valuations determined? It's a mix of science and art. Now, let's delve into the factors that sway the IPO's offering price. But here's the real nugget. How do you determine if an IPO is overvalued or undervalued? Let's start with the price-to-earnings (P/E) ratio. A high P/E ratio could mean investors expect rapid growth, but it might also indicate an overpriced stock. Rapid growth can justify a higher valuation, but be wary of unrealistic projections. Now, compare the company's valuation to its industry peers. If the IPO price greatly exceeds competitors, be cautious. It could be a sign of overvaluation. Lastly, assess the company's future potential. If the IPO price seems disconnected from the company's potential, it might be a red flag. With these strategies in your toolkit, you'll navigate IPO valuations with confidence. And there you have it, intrepid investors. We've journeyed through the intricate world of IPO investing, unraveling the secrets to spotting promising opportunities. As we wrap up this enlightening experience, let's reflect on the importance of due diligence. Your investment decisions shape your financial future, and the more you know, the better your choices. If you found value in this video, don't forget to hit that like button, share your thoughts in the comments, and most importantly, subscribe for more valuable insights.